All right, I hope it's working correct. Welcome to my first live stream. Let me check and see if I can pull it up here. That makes no sense. Okay, there it is. Okay, it looks like it's working. Cool. I am going to take a look at the market. It's already starting to move, which kind of sucks because I wanted to start it a little bit before this, but I'm in the tastytrade platform. The market was down about 20 points a few minutes ago. I noticed volatility was up a little bit, even after yesterday. Let's actually zoom in a little bit here. I was going to say before the market started moving, it was probably going to either hold where it was. Um, let's actually go back to the main chart here. So I was going to say that it was probably going to hold where it was, down like 20 or so, and go back up and stay in this range, probably under 6,900, or it might end up dropping a decent amount. I think it could probably drop $50 today, 50, $60. Um, the reason that I say that is because of what happened yesterday. There was kind of a big move up and down yesterday, and then it kind of stayed in the. It didn't really go anywhere, stayed in the same place, but volatility went up. So the market was up a little, but volatility was up. When that normally happens, the next day you have potential for a big down move and volatility to increase again, which is exactly what's happening. So the last couple days after this big drop, volatility spiked up over 22. That was the perfect time to put another like 111 trade on, or just sell a naked put, and obviously that would have paid a lot the last couple of days. Um, or another strategy that I've been following, I haven't been trading it as much, um, is like a one for one trade. When you get these big dips, basically you just sell a put spread at the money and risk what you collect. So you can like risk. I normally do it on SPX. So you can just set it and forget it. You risk 250 to make 250 or 500 to make 500. Um, and you just do it like every day basically, and you just ride it back up. So every up day you would make a decent amount. Even on these down days, if you put it on at the end of the day before, and it opens up, then you can just close it out and take some of that profit. But then when you get these moves, kind of like there's one here where it didn't really go anywhere, but it moved more than the expected move. Then you have these big down days, and the down days they always cluster together like that. So that's kind of what I was looking for. Now we're already down 33. So I think it might continue. You might get volatility popping up again, possibly over 20, but we'll see. Let's go to the trade tab and we'll look at something I was recommending the other day. I have a picture of it. I remember what it was actually. Um, it was 80, 82, 83 days to expiration. Now it's 78 days. It was when the market was dropping a lot. So it was this wait, now I gotta zoom out. I need to get my mouse too so you don't hear all the clicks. Just go here. So these days when the market was dropping on the 7th, that's when I was looking at this trade. The market was around what 66.50 or somewhere like that. So I was looking at just selling. It was a 45 delta put. That's around the 6600. So something that I've been, this is like a combination of a couple of trades. So you would probably already have a 111 trade on, but when the market dips, take advantage of that and sell another put. That's what I like to do. Um, and if you have a lot of money on the table or on the side, you can sell up to like a 45 delta put is normally what I look at. So that was that. And the 111 was around 63, 61 was the spread, $200 wide put spread that I was buying, and then I was selling the 5,500. It was all even, kind of even numbers, so it was easy to remember. And we'll just look at that first. I wanted to show what it looks like here. You get this little step up. So actually, let me show what it looks like without the 111 on. It's just the short put. So I mean, most people know what that looks like. You were getting a lot more of a credit though. It was like a $200 credit. Oh, I'm trying to put it in. So with the $200 credit, it doesn't update the numbers, I guess, because I have the other stuff in there. But that's what it looks like with the put spread, right? So if it starts going down, you instantly start losing a lot of money. But when you have the 111 on, you get that little step. So it brings your break even way down. And then you get this little step here where you lose a lot less for a while and you get more of a credit. But what I found that was really interesting when I was looking at this last week was if you increase this put spread, that takes away from your credit on the tail end, but you get this point here and this dip, and let's go to like the end of the year. What happens, we can even go a little bit farther, all the way up until a couple weeks before it expires, that you don't actually lose any money in this dip, or you don't make any money on the peak here either. It smooths this line out, so you almost don't lose any money. You don't make any money, but you don't lose any money here. And if the market stays or goes up a little, you make everything on the other end. And that's without adding any more risk. There's just two naked puts. But if you add a little bit more risk here on these puts, you actually, it keeps moving the break even down, right? And it increases your tail on the high end too. So I thought this was really interesting. Probably wouldn't do a bunch of them like that, but so you turn that one naked put, instead of losing any money here, it evens it out all the way down to, what would this be, like a 10 delta? I mean, here's your 2 standard deviation line. And like I said, this was the trade that I was looking at, it was 4331, and it was a $215 credit. So this is kind of what it looked like. You make $1,000 on the high end. You have this dip here that actually goes under where you would lose money. See, it says P&L at expiration minus 385, 415, 420. But the theoretical profit is like $500. You make like $500 there. So you don't see the peak and you don't see that dip. It just smooths this line out really nice. And your break even is all the way down here, like 1,000 points below where the market is now. The buying power to do this was $3,500. Now it's only 28 because the market's moved up a little bit. It's going to give you back more buying power. It's 5 naked puts because you have 4 here and you have 1 here. So you really don't want to do this kind of trade unless you have $3,000 to $4,000 for each naked put. So you really want to have like $15,000 to do this, maybe a little bit less. You would be okay. You would just have to make sure you manage it if it does start to move against you. But if you hold $3,000 to $4,000 for each naked put, then you can hold this trade all the way until expiration without having to worry about it, or you can then at that time you can roll it out. But that was the most interesting thing I was looking at the other day. But if you don't have that, you always want to have extra money on the side too, because what volatility was at 22 when I was looking at this the other day. You only want to be using, I would recommend, or what I normally do, I only use maybe 30 to 50% of your buying power. So you want to be able to do more. So I would do this in like, a $40,000 account or $50,000 account. That's what I would look at using that like $15,000 or maybe a little bit more, just for this setup. And then with the rest of that money, so let's say you have a $15,000 account and you put, or you have $15,000 that you're going to use, right? And keep on the side. You would only be using $3,500 to actually put this trade on. But you should have at least, $15,000 or maybe $20,000 just to be able to hold it in case it went against you more. You could take the rest of that money and put it in something that's risk-free or really low risk. So I would recommend something like SGov. This just looks weird. You would just buy it, but this is just a risk-free. I guess I can pull it up this way. Risk-free. They put it into treasury bills. Make sure I'm not showing anything here I don't want to show. But you get over 4% risk-free. So you take the rest of that money and you put it into this for a couple months. You hold it for 3 months, you're going to get 1% return for free. So you do that with the other money. So if you have $15,000 and you're using $3,500 on the futures options, then you put the rest in here and you get 1% return for free, no risk. Goes up every day, and then you get the payout, and it goes back up every day. So that's pretty nice. Just got the futures, the micros pulled up here. It's the easiest way to scale in and out. You can do it with a really small account. But if you're looking to just get started, if I was looking right now, if I didn't have anything on and I wanted to put something on, today would be a good day to do it because it's down. Everything's down a little bit. You could just start with one naked put somewhere. You could just sell the 6600s now, put up $2,000, but you want to be able to hold it if it goes in the money, right? So if you slide that down in the money like that, this is why I say you want to have $3,000 or $4,000 for each put. If it goes in the money, a 90 delta put is $4,100. So you want to be able to hold it if it does go. You don't normally hold it in the money. I normally roll it if it does get at the money. If you sell something that's further out, like I don't recommend selling a 45 delta right away. I mean, you can a lot of the time. You want to do that on a down day for sure, but you want to be able to hold it. So a 45 delta put is around $3,000 in buying power. But you can start by going out to, I normally look at like a 25 delta. So it's only $2,000 to sell 25 delta. But like I said, you don't want to get a margin call if it goes in the money or at the money. So you want to make sure you have more than that to cover it. But like I said, if you're selling this for $2,000 and you have another $2,000 on the side that you're saving, that you want to reserve just in case this goes in the money, put that into SGov, and then if the market starts dropping and this does go into the money more and you have to put more capital towards this, just sell some of the SGov to free up that capital. Or you can always buy a put, but I don't normally recommend that when the market's falling. But that's one way to help, because you buy a put way out here, it'll take away your profits, but it reduces your buying power. So that's a good way to keep the trade alive, kind of. You never really want to close the puts that you sell. You want to do something else to get your buying power back. But around here with volatility at 18, if you don't want to just sell the naked put, you can always do like a 111 kind of at the money. That's something that I look at. That's my favorite trade is a 111. If you scale that right, it basically always works out. You just have to make sure you don't trade too big. That's the worst thing. And I like to do them different sizes too. Sometimes I'll do it like $300 wide. You can buy at the money or in the money a little bit like this. Sell the other part of the spread out, and then you got to take then you can sell near the the one standard deviation, 16 delta, 14 delta. Sometimes I'll buy like a 50 delta. So you can do a $200 wide and sell the 62, and you're actually buying it. But I'll show you what it looks like on the curve chart. Gotta go back out again. So you don't really have any risk to the upside, just whatever you pay. It's like 50 bucks. But there's not much risk. You only have to put up $600 to do this. and you actually, if it stays here, you kind of want it to stay here. Let me zoom back out in time, show you what this looks like. So you see you actually get the hump. The top part of the hump is actually close to the put that you buy. That's why I buy it at the money. It's almost like a strangle, but you have no risk to the upside except what you paid. All your real risk is to the downside. But it moves. You lose money a lot slower when you have the put spread kind of covering the naked put. And then as time goes on, you can see the hump just gets bigger and it starts to move down a little bit, but it stays around where your put spread is. So you can see that the price is at the top. That's how much money that you could expect to make. So you'd only lose a couple $100 if it went way down here. Now volatility would increase, so it would be more than this. But as long as it stays in here, this is what you can expect to make. Even if volatility comes down, if it stays here and volatility comes down, you'll actually make more than this, which is what you want. But as time goes on, so this is about halfway through the trade, you'd make the most money right here, a little bit inside your short, in between your two shorts. And as time goes on, your buying power will decrease as well, unless it moves way down here. This will actually go down and down and down. So you can put more trades on. But yeah, you should have like $3,000 to $4,000 to put this on, and you can make $400. Even if it goes up a little bit, you'll still make $200, which is pretty decent. That's a few percent in like 40 days. So $4,000, $400, that's a lot. You don't have to do anything with this trade. You just put it on and you let it go for a while. If it does drop down here and you're starting to lose money, because volatility will increase, so this line will drop if it moves down too fast. So it moves down. If it moves down close to your short put in half the time, you'll probably be losing a little bit of money. But what you can do is you just put another one of these on down further, and you kind of get what it was looking like before. You'll have the one short put, and then you can put another one on down here and collect a higher credit. So it's pretty interesting. You would get like a step here, so you move your break even down, essentially. That's what you're doing. And if it lands inside one of these traps, you can leave this one on if it does start to drop, and then you make what's in the trap, which is $950. So if you're putting this on for you put it on for $600 and you want to have at least $3,000 or $4,000, but if it does get at the money, it's going to be $3,000 or $4,000 to hold it. But then you can make, if you leave it on all the way till expiration, you make $900 on it. So it's actually really nice profits. And you just got to stay small. Down 30 now, so it's just staying here. It's kind of interesting. All right, now the market's open. So we'll see what happens now. I think it could be a pretty big down day. We're already getting kind of a queue, but you never know. This could be the bottom of the day also, and it could go back into that range I was talking about earlier. Let's look at that. Go to the minutes. I really like this indicator on here. The green is 1 standard deviation, the blue is 2 standard deviations, and the red is 3 standard deviations, which basically never happens. What's the 1 standard deviation is it'll stay in there about 70% of the time. The 2 standard deviation, it's like 95% of the time. And then it almost always stays within the 3 standard deviation. It's like a 99% chance. So you can see where we're at open, and I guess I can't see farther. Maybe if I move this. Yeah, here's 4 p.m. So that kind of gives you an idea of where you can expect it to close at the end of the day. This up a little bit. So we'll see where it's probably going to stay inside the green. Oh. Yeah, that's actually pretty close. Yeah, so there's some numbers that are probably going to be pretty accurate. So the 67.40, 69.50 to the upside. But honestly, I think it's more like it'll probably stay within the green to the upside, but it might dip down here. If it does start to drop, it'll probably go lower. But this will change throughout the day too. So as it does drop, this whole thing will move down. You can see volatility down here. This was at the close yesterday, and now it opened way up here. It's already like spiking up this morning a little bit. That's not what I meant to click on. Volatility kind of leads. But I normally use VIX, different levels in VIX to kind of tell me how to scale. I think I have some stuff on here that I put on before. Yeah, you can kind of see the different ranges. Maybe zoom this out. This is kind of interesting. I was messing with this the other day. 1 day, go to a year. This is kind of how I scale. We rarely get down into this red area, and the red area is when you have the most risk. So I only have one tranche on when we get under 15. And sometimes I'll even get short instead of just even having one put. I'll normally have a 111 where what I was showing earlier, which when you put a 111 on, it's pretty delta neutral a lot of the time, unless you're buying it for a little bit. Then it'll start with some short deltas, but as the trade goes on, it gets more short deltas, which means you'll make money if volatility goes up and the market drops. So I always set my traps when it's in between 12 or 15, which isn't very often. This is a whole year, and it got down here for a few days. It'll hit that level. It hit 15 a lot over the past year. And every time it hits 15, it spikes back up. So it spiked up here, kind of grinded up there, spiked up here, spiked up here. So it hit here and spiked up again. Kind of floated in here for a little there, but that was a decent spike there. When you see things like this, that's what you want to take advantage of. But as it stays in here in this range, a lot of times the market's grinding higher. So you won't make as much money unless you have another short put on your 111, which is like kind of what I was showing at the beginning. But when it goes into, make this bigger, when it goes into the orange zone, you can kind of sell some short puts, or have your 111 trade up higher. And then when it's in between like 18 and 22, see it goes up. It's over the past year, it's hit 22 quite a few times. It doesn't normally go over it. It's just something that I've noticed. You know, hit it here, but it's only one day. Like one day it hit there, one day it hit there, one day it went over here. Just did it again the other day. Here it went up, and then it actually continued up a little bit. And then like this was a crazy move. And this happened once last year too, where it went to like 60. Did it twice in the past year. It went all the way up to like 60. That's kind of crazy. That's what you want to make sure you don't get margin called when that happens. But you want to make sure that you can take advantage of that too. And you're going to make the most money. If it ever goes up into this green zone, 25, normally 25, 30 or higher, you almost want to always have one tranche left that you can do when it gets up 40 or higher. But it rarely ever happens. So you want to really take advantage of the green zone, but you still don't want to be all in, if that makes sense. But most of the time it's going to trade here in the orange and the yellow. So you just want to be really careful if it's in the red, and you want to be, I guess you can say, greedy if it gets up here, but you got to be careful because you're going to still get big swings. That's why you want to make sure you don't ever get above. You want to always have that some of that money reserved on the side. You know, if the trade costs $1,000 to put it on, you don't want to only have $1,000, because if you get a spike like this, then you're going to have to close the trade for a big loss. This is what blows up people's accounts when this happens, if you don't scale right. But if you can hold the trade through this, then you know it's guaranteed to come back down. Even if the market doesn't go up, volatility will come back down. So we'll see what happens today. I don't know. See, look, it already popped up and now it's going down. So this is a big down day today. This is what I was kind of expecting. Let's go back to the NES here. Back to the minutes. But I don't. Days. I don't like to day trade or anything like that, even though it would have been nice to get short this morning. It's just a good time to be selling puts. Days like today, like I said, it could probably go down to the 68 level. I was thinking down 60 points today. It's already down almost 50. I should have, I don't know how I can get the indicator to stay in one place. I was trying to move it back. I can show you here. It's called the probability of expiring cone. And there is like a start date here. But see, I have it set to 11.4, but it's following the market, so I don't know exactly how to move it back. But I mean, you can see the speed of the move. It's like I was saying, it's probably if it keeps falling, well, as volatility increases, this is also going to get wider as well. So it could stay inside. It could still stay inside the green as it moves down, but I wish it was pinned back here. So you can see it's moving down more like steeper than the green line. So if it was pinned back here, it probably would be down in between the green and the blue anyway. But we're down about 50. We're going to be down 50 any second now. Volatility is just spiking up. You don't normally see the green line up there with the blue with the red line like that. All my research that I've done shows that when you do sell puts further out in time, I know Tasty talks about what 45 days. Some people sell 60 days. Which isn't bad either. But you're gonna probably make a little bit more money if you sell shorter time, but you have to manage it a lot more. And I try to figure out a strategy where, so now we're down 50. I try to figure out a strategy where it's the least stressful, right? I want to make money, but I don't want to stare at a screen all day. I don't want to check my computer every day. Everything that I've seen, if you sell around 90 days, that's why I was looking at like 80, it was like 84 days or something like that when I was looking at it. If you sell around 90 days or a little bit longer, like even the 99 days we could look at, you don't have to stare at a screen all day. You don't have to make adjustments. Um, you scale in, you scale out. Like when the market's dropping and you're losing money, you just scale in more. And if the market's not really moving anywhere or goes up, you can take profits. Um, you can roll trades out, but 90 days, you don't really have to roll trades out. You might roll them out one time, but normally you either can take profits before then, put another trade on 90 days out, um, or you just hold it. You can hold it to expiration. Normally within 90 days, if the market does dip down, it comes back a lot of the time. Or it'll just stay there, like I said, and you can hold it to expiration. So now we're already down almost 55. I'll look at the open interest a lot. So I have the open interest up over here. You can see what other people are doing. Always see these big ones stand out to me. 1600, like this is 53, and then this is 1600, and then this one over 1,000. So what are they doing? It's kind of interesting. Let's go up one here and see the open interest. See, like there's nothing way out here, but this one stands out. The 5 delta again. These two. Okay, so actually this is a perfect example. So it looks like somebody might be doing, I always see this all the time. This is only $50 wide, so it's really small, but somebody could potentially be doing this trade here. Now this is almost double these, right? You got 300, 300. I'm just going to round them up, and then this one's almost 600. So it looks like somebody could be doing a 112. This is really tight. I don't really like doing them that tight, but this is what it looks like to me somebody could be doing. they have basically everything covered. You want to have, it's just two short puts, so you want to have $8,000, let's say, but it only costs you $1,000 to do this. And what, this is halfway through the trade, and we can go to today. I don't know why today looks like this, because this should be down here, but we can go to the end of the year. Where am I again? 70 something days out, so something like the end of the year, or a couple weeks before it expires. It's kind of interesting. I mean, your break even's way down here, 1,000 points below the market. Like I said, if you have $8,000, you're doing this with like $8,000, you're gonna make 200 bucks, possibly 300 bucks. It just stays here. Maybe 400 if you wait a little bit longer and it falls into your trap. See, like there's $400 there. But the max is what, 430, so you would have to really hold it all the way till the end. But it's interesting that you make more here on the theoretical P&L than you would at expiration. Like you don't make as much here, but that's your trade-off. You don't make as much here, but you make more here. So you kind of want it to always be near your spread. Because you don't want it to get over here, because then you start losing money really quick. But that's a 2 standard deviation line here, so it's less than 5% that it'll get down here. And you lose a couple $100. If it gets to your short put, you're going to be down a couple $100. I mean, it would be more because volatility would expand, so it would be more. Let's say $1,000. In here, you probably wouldn't make that much. You would only make, it might actually be like down here. But if it stays towards your short spread, I mean your long spread here, this is what you would make. So you can make the $300 to $400 in here, which would be nice on an $8,000 account. That's what, 5%, and this is 2 months, 2.5 months, and that's kind of what I look for, 2% a month, just on this one trade. And if it does go down here, volatility increases more, and you have, obviously you should have a multiple of that. If you're just in one tranche here, I always recommend you should have like 4 or 5 or 6 tranches or even more, to be able to scale in and out. 4 or 5, mainly use 4, and then have a 5th one just in case. But yeah, if it does drop here, you can sell another put. Like you can increase one of these, and then you'll make a lot more when it goes up. But obviously you'll lose more. It takes away your break even there, doesn't it? But you'll get a lot higher of a credit too. If it does drop down here and you sell this put, it would probably be double that. So maybe another 90. So you could change this to like 210. So you scale in another one, that's would be like another $4,000, I would say. So it would be 12,000, and then you make anything on the long tail side, you make $1,000 off of $12,000. So that's really good profits. And you can do the same. You can put more 111s in here, or another put spread. I wish they let you analyze more than 4 options. I wish they let you do like 8 legs. That would be really nice, but if you have positions on, you can analyze what your portfolio would look like with your positions on and another trade. So that's kind of nice, but I don't have any positions on in this account. But then you can like turn them on and turn them off and see the difference. So it's a really nice feature. But you could also just double everything as well. Or you could do another 111 instead of a 112, and you would get more. So it would be like, I don't know, maybe 75. So you always increase that tail a lot. But you can also add another short put, like I was saying before. It does drop down here. You add another short put here somewhere. And it almost looks like what we were looking at before. Increase this another one. It's not wide enough. You can almost put, like, if it drops down more, you can put another short put in here somewhere. And this would be, like I said, this would be double. So you can add another like 45 onto the 86. Should be like 130. So you got to mess with it a little bit, but so this would be like three naked puts. Then you're making, $12,000. You make 400 bucks up here, 800 bucks in the middle. Which the market would be down at this point if you're doing something like that. You put another 111 on down here further out in time, and that would smooth out your risk. But if you notice, this doesn't come down that fast because you only have the one put here, but then after the two puts, then it would drop down pretty quickly. But you don't want to get down in this range. You don't want to let the price get down there without doing something else. But now it looks like it bounced up a little bit. Oops. It's interesting. But the down days will cluster together. There's always a bunch of down days in a row, so you got to be careful. This will spike up a couple days in a row. So it might be down 60 today. We might be down 80 tomorrow or 100. It could be back down here again. But I don't know. We'll see. That's where the risk is. The risk is to the downside. I don't think you have much risk to the upside right now. You had risk to the upside after this dip. It's like these big dips happen, then your risk is to the upside. But when you get up here, after you get a good move to the upside, then your risk is always to the downside. So it flips back and forth, But a lot of times after these big dips, you'll get like 10 up days in a row, which is kind of interesting. So you got 1, 2. I mean, this was even higher, right? It closed here, but then it went up again. It dropped, but this was still an up day. So it's pretty crazy how that works. I'll be right back. To use the bathroom. sure the other thing I was talking about too. When you get these big down dips, like these big down days. I mean, even here. So I mean, it happens a lot. So you have a decent down day here, comes back up. Your volatility is going to come in because this big move is actually we can look at it. So September 2nd. September September 2nd. So you had the big spike, and it ended up coming back down. A lot of times when that happens, your volatility is going to come back down. So the market's going to turn up, and then it grinds down a lot, or it stays here like I was saying earlier. To kind of stay in the same range, but the market will go up. So you had this big dip, and then it was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There's 10 up days right there. You had another dip, 1, 2, 3, 4, 5, 6, 7, 8, and then another big drop. 1, 2. I mean, they were all up a little. Then it kind of freaked out a little bit, but volatility still probably came into this day with the October 16th. So that big spike was this big spike. 16th, the 16th shot up a lot. That's actually pretty interesting. And the 17th, it dropped a lot. I mean, that's a big spike there up to almost 30. I mean, it breaks through 25 on both of these, or above 22. That's kind of what I look at. 20 between 22 and 25. I mean, you always want to watch out for a big down day like this, because this could continue, but it's probably not going to continue as much. But it actually just reversed right away. So there was a lot of potential for this to continue, but if you just do those one-to-one trades, if it does drop a bunch, you only lose, what you risked, which isn't, you can lose 100% or make 100%. You'll have bigger down days than up days, but you'll have less down days than up days. So that's why I really like that strategy. But so if you started it here, you even did it through these days, you'd have 1, 2. I mean, you can even, if you trade it during the day, I mean, I normally put it on at the end of the day, so you can see this. The end of the day, the market was here. The next day, it went up. It ended here. The next day, it went up a little bit, went down, ended in around the same spot. So you'd probably lose there. Put it on for the next day, went down, went up. You'd make it on that end, but the next day it went up a little bit. So if you were lucky and you put it on here and it went up the next day, you could probably have taken profits. And then you put it on at the end of the day, which is down here. The next day, you just leave it on. If it goes down, you leave it on, because the only thing that's going to happen is it could come back up, or you just lose that day. But if you put it on here and it dropped down here and you left it on and it ended up here, you would have made money. You would have definitely made money on this day. And then you had these couple of moves, 4 days up, big every day. You would have easily made 100% each day there. So you make 100% here. You make, let's just say you make 100% here, you lose 100% here. You make 100% here, you lose 100% here. You make it here, here, potentially lose these two. So you're even, right? You're even at that point, and then you make 100% 4 days in a row. So in this group you make 400% doing that trade every day. And then when something like this happens, what is that, the 29th? This is a sign to kind of get out and not do it for a couple of days. See, volatility jumped up, and the market kind of freaked out. It's priming for a down day. When I see something like that, I think the market's going to be down the next day, which it was, which is what happened yesterday. It kind of freaked out a little bit, didn't really go anywhere, but it pumped up volatility a little bit, and now today we got a big down day. So that's something that I can kind of see it here. It went down but came back up, and then it dropped. This one you don't really see it as much. But as the market goes from here to here, volatility, I don't know, I'm cutting out. When it goes down from here to up here, volatility is going to come down. So when you do get a red day like that, it starts putting volatility into the market, and you have a lot more potential for a down move. And they cluster. So when that happens, then I don't trade that for a couple of days. I mean, it happened again here. Volatility probably came in a little bit, and then but it probably was also increased. What, November 3rd? Let's look at that. Yeah, see, volatility came down, but it was still higher. It was higher, but it came down. So it was kind of weird. You don't really know. It could just keep going down, but it decided to spike up, and this down move kind of continued. So this is a lot of down days in a row. But right after that, boom, you got three good up days. So it depends when you want to flip it around. You could have saw this and started here, and you would have made money that day, but then you would have lost 2 days in a row. But then you would have made it 2 days in a row. I don't know if you would have made any that day because that's a little bit too close. But if you started it down here, if you see this spike and it comes back up, a lot of times when the market is dropping and it closes at the bottom, it'll probably continue. But you get these drops and it comes back up. That's normally a sign it's going to go up higher. So it didn't happen here, but it did happen here, and then it just grinds up. Kind of happened here, grinds up. Kind of happened here, grinds up. But if you did it through this, you would have made if you put it on at the end of the day here, you would have made 100%. You would have made 100%. You would have lost 100%. You would have made 100%, made 100%, made 100%, made 100%. Would have lost here. That's kind of interesting. I might have stopped at this point. September 12th. No, it's still lower. That's weird. The 15th. Volatility went up a lot that day, but the market also went up. Or no, yeah, the market also went up a lot that day. So that's kind of strange. But you had this was 10 up days, and you had 1, 2, 3, 4 down days. So you would have made 600% doing it every day here. So it's a really interesting strategy. There was a guy that made $1 million in a year from like I forget what he had, like a $30,000 account, and he turned it into $1 million doing that strategy, just risking 1-to-1 every day in SPX. I'll show you how that setup works. Sometimes you can do it during the day, but probably should have put it on. Oh, what's at 10 o'clock? You could probably do it now. But I mean, that's it. You sell a put spread a little bit in the money. If you can do it this small, you risk 260 to make 240. I mean, you risk 240 to make 260. Now it's moving a little bit. But yeah, I was right the first time. Like right there, 250 to 250. You just need the market to go up $6. If it goes up $6 and closes, you make 100%. So it's interesting, and you can do it wider if you want to risk 500 to make 500. You just widen it a little bit, but your short is at the same spot, so it only has to go up like what, like $8 now from where it is and close, which it just, I mean, it just went up $8. You probably could have done this here and risked one to make one. This was probably 500 a couple minutes ago when the market was down 50 or even more. So you would have already made like 70 bucks on this trade if you did it when the market was at down 50. But you just do it every day. Just do it every single day. You can look at it for tomorrow. Got to go a little bit higher. Tomorrow the expected move is $50. You can put this on and it just has to go up $15 and you make 100%. It's an interesting, really interesting trade. It's more kind of like day trading almost, because you got to do it every day. But you can just let it expire to cash. It's really interesting. I mean, look, it already moved up right now. Boom, done. So if you did put that on, it was just 265, 260. Probably could have gotten filled at like 255. It's already trading for 210, so you'd already made like 40 bucks easily. But yeah, if it just closes here now, you make the rest of the $200 just off the $5 wide, or if you had it spread out. This was just 500 bucks, and now it's 400 bucks. So you could have just made $100 that quick. Even more, because it's going up more. So it's pretty interesting. You want to see it didn't drop as much as it did before. You have higher lows here. It's back up to where it opened at. So if you get a little bit more of an up day here, it could turn the market around. Like today could be that pop in volatility. Short term, it might just start grinding back down again, or just staying around here for a little bit, which the market will probably just keep grinding up higher at that point if it just stays in the same area. So those are the trades that I've been doing and exploring. I've been doing the 111 trade for 4 years now, and I don't have like basically no losers. I've had to roll a couple of them, but that's been my most profitable strategy by a lot. Just kind of started doing the 1-for-1 trade. But I don't do it every day, and I beat myself up over it, because if I was doing it every day, I would have caught a lot of these big moves like that. That would have been awesome. I mean, here again, you'd make it here, 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 here. So that's like, if you catch it at the end of the day here and you start doing it, it's 1, 2, 3, 4. I don't know if you made it here. 1, 2, 3, 4, possibly 5. You would lose here, so back to 4, and then you make it here 5. You make 500% in this stretch. You can make 600% here, 500% here. If you miss the couple of down days, which you're going to hit that one because you're just not going to know about that. So, I mean, even take a couple 100% off there. If you make 400% here and 300% here, making 700% in a month from September 2nd to October 2nd. 700% in a month. It's kind of crazy. But if you want stress-free trading, then I definitely recommend doing the 1-1-1 strategy. Find what works for you. Trade out longer in time. You really should do it on futures options because that gets you the most leverage. But you can go out 99 days. You can do it lower. Sometimes I'll buy the 30 delta and sell like the 22, and then you just go out here and you sell something for like $35. Whoops. So in a 2 standard deviation, you might lose $1,000 or a little bit more. But in your trap, you make $1,000 here, and then on the tail, you can make a couple $100 if it kind of stays where it is. You only have to put up 500 bucks. So it's just doing one. But people would do the 1-1-2 strategy. This is what some people used to do, and the risk is too much to the downside. So that's why I always do the 1-1-1 instead of a 1-1-2. I mean, you can do this, just make sure that you're holding, $8,000 for every one of these that you do. But if you just do a 1-1-1, I mean, you can see how it moves the tent down, moves your break even down. You're not getting much more. This is $400 here. Now it's like $200. So you're only, you're doubling your tail, but at what cost? You're also doubling your risk on the downside, or tripling your risk on the downside. The spread helps a little bit when you're selling one, but if you're selling two, the spread does nothing. It really doesn't help at all. It's unless you get into the last week of the trade. So I mean, this is 30 days left. The longer you're in the trade, the more the spread helps. And you always kind of want to close early because I mean, you don't have to. You don't have to when you do this, but this put at least. You can leave the spreads on sometimes. If you make enough to cover the spread, sometimes I'll roll this either up or down. Or add more, like I was saying. Add more, add less. But yeah, that's it. That's it for today. Now it's only down 29. So it looks like it's coming back a little bit. So if it only ends down a little bit today, then that's gonna bring the volatility back down. And we're probably just gonna keep grinding up higher at this point. If it drops back down here and closes down here, then we're probably gonna go a little bit lower. So that's my analysis on that. And you can also do the strategy in the other product I recommend is oil. The micro crude. But instead of doing puts, you do calls. But you can kind of set the same thing up. It's a little bit cheaper. So you buy a call, could be at the money, could be lower, and then you just sell something down here. It's basically the same thing. The risk in oil is to the upside, not to the downside. Whoops. So, it shoots up here, you lose a couple $100, you make a couple $100 in the tent. Whoops, I'm messing it all up. Move the whole thing down. But you don't have to put up as much money. If you sell, you can look at selling an in the money call here, like a 90 delta call or anything like that. You only have to hold $1,500. That's how you can scale. That's how you figure out how much to scale, because even if volatility increases in futures, it actually makes the buying power cheaper. So when volatility is low, you have to put up more money. When volatility is higher, it's kind of like the opposite of stocks. When you sell options in stocks and volatility is low, it's cheaper. When it expands, then you have to put up more money. But you can kind of gauge it by doing that. So $1,500 for each one. But then when you sell way out of the money, these cheaper options, sell something out here, you only have to put up $700. So you don't get as much leverage as you do in the micro S&P. But like I said, you can do these, maybe hold $1,500 to $2,000 for each contract instead of $3,000 or $4,000. So you can trade a little bit smaller here, but you're obviously you're not going to make as much money. So how do I end my stream? All right, well, that's it for today. If you watched this and you got any questions, leave some comments. I can cover different things. If you have no idea what I'm talking about, same thing, just ask me some questions and I can explain some stuff. But I like to use these products because they got tight spreads. You can always get in and out easily. Only a couple dollars here. You normally get filled at mid price. If you want to sell this, well, I don't recommend selling calls. You sell a put, you drop it down a little, you're going to get filled. You're going to get filled at that price. I need to set a hotkey for my stream. All right. See you.